Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, January 30th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be inclined to 42 macro. So today's key macro question is AI inherently inflationary, not deflationary, inflationary? Our answers are a slew of Mag 7 and other big tech earnings events have us revisiting the topic of AI. A cursory review of today's Bloomberg News headline shows just how dominant the theme has become to every investor in the world, either explicitly via direct exposure or implicitly via the concentrated global macro market risk that the AI theme represents. When the AI trade stops working, investors are unlikely to generate positive absolute returns by rotating into other risk assets like Bitcoin to manage risk. Correlations will approach one across asset classes when capital is destroyed on the scale it eventually will be when the AI trade stops working. We are in a fourth turning, an era of great institutional, technological, and geopolitical change. Once-in-a-lifetime outcomes occur during fourth turnings. What happens to tax receipts when AI displaces a critical mass of white-collar workers? What happens if an AI-driven U.S. fiscal crisis is the thing that catalyzes the potential loss of U.S. dollar hegemony and the U.S.'s exorbitant privilege? If those institutions are ever up for serious debate, we should expect such disagreements to eventually catalyze World War III because, of course, we, the United States, are not going to relinquish that immense power without a fight. All this suggests that the ultimate outcome of AI may be more inflation after a transitory period of disinflation or deflation. We saw a preview of how both Republican officials and Democrat officials respond to mass unemployment during COVID, massive budget deficits that were largely monetized by the Fed. Moreover, total war is the most inflationary dynamic that has ever existed in society. Protect your family, protect your wealth. Know that we built our KISS portfolio construction process to help ordinary people just like you do exactly that. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's regarding PBOC QE. It says, hi, Skipper. Thank you very much for all of your hard work. Thank you. Appreciate that. I find your research invaluable. I'll very much appreciate that. The question is, could the pullback in Chinese government bond yields be a function of the PBOC applying some form of stealth QE? It was applying stealth QE prior to December. In fact, let me take up my Bloomberg here. If we look at the growth rate of the PBOC's balance sheet, that's the bars here. Those are the 3-month annualized growth rates of the PBOC's total assets on the PBOC's balance sheet. Through November, the PBOC's balance sheet was compounding at a 13.5% annualized growth rate on a 3-month SAR basis. In December, that plus 13.5% 3-month SAR decelerated to a minus 12.8% 3-month SAR. So a significant reduction in the PBOC's balance sheet in the month of December. And this is exactly what happens when the dollar gets too strong. Countries start selling down their foreign exchange reserves to buy US dollars in the open market, and ultimately it causes the balance sheet, the total assets on the balance sheet, to contract. So this is we talked about this ad nauseum in recent months, but one of the key risks for 2025 in the context of the likelihood that we see fresh tariffs levied against China and potentially other U.S. trading partners, in my opinion, the risk isn't the impact that it's going to have on the U.S. economy from a kind of transitory stagflationary perspective. The big risk is the financial market risk associated with a too strong U.S. dollar, because historically, and both in recent times, but also across decades, we've seen currency or countries that are offset tariffs with currency depreciation. And if we get a too strong U.S. dollar in a year where we have peak global refinancing demand, it's just not going to look good. You're going to be having the strong dollar drain liquidity from the system that requires a significant growth rate of liquidity. And so a lot of folks are counting on PBOC balance sheet expansion to be something that ultimately catalyzes a significant acceleration of global liquidity in 2025. And we are expecting the PBOC's balance sheet to recover from here. We're not going to expect it to contract indefinitely. But again, if the yuan gets too weak as a function of this, then they're going to have to start, putting a draw on the floor, a line in the sand, and ultimately start shrinking their balance sheet by just deploying FX reserves to support the yuan. So again, I think we're thinking 1 or 2 trades ahead from the current trade. So I want to be very clear about all these dynamics. And then going back to the question with respect to the PBOC's bond yield. So clearly, in my opinion, it's not a function of the PBOC applying stealth QE. At least it was through November, but certainly not in the most recent month. What has helped the PBOC's bond market is a function of several things. One, China's capital misallocation, their overly indebted private sector, and their horrible losing world demographics. I mean, the worst demographics in the world, worse than Japan's at this point. Their demographic curves, those three dynamics are contributing to secular stagnation in the Chinese economy. And so in our opinion, we think the Chinese government bond market is just repricing to a lower level of yield to account for the fact that nominal growth in China is going to be structurally challenged and increasingly structurally challenged for a long period of time. They're heading into a balance sheet recession. Japan has recently exited a balance sheet recession that took them almost 2 decades to, fully process through. So this is going to be a very long period of time in terms of getting China back to more healthy economic footing. But one thing that the Beijing has sort of implemented in recent months to kind of delay the onset of that or the deepening of that balance sheet recession is they've panicked in monetary terms. We've seen a reduction in loan prime rates. We've seen a reduction in triple R rates. We've seen a reduction in 7-day repo rates, 14-day repo rates. We've seen a significant reduction across the curve and across a variety of tools from the perspective of the PBOC's policy rate setting. So that's also created some downward pressure on bond yields in China. But in our opinion, what's really driving the tail wagging the dog there is just China's horrible debt demographic and capital misallocation dynamics. So if you guys want details on that, obviously source our monthly macro scouting reports. Obviously, we talk about all these things in those presentations. So we'll wrap it up there. Darius Dell presenting our macro minute for Thursday, January 30th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.